Somewhere in the world, a bank is paying a customer 0.5% interest on their savings account, and at the exact same moment, that same bank is charging someone else 11% on a personal loan. The difference between those two numbers, that gap, is the entire business model of modern banking, quietly running in the background of your life every single day. And the wild part? Most people don't even know it's happening. I want to talk about something today that most of us interact with every single day but almost never actually understand. Not really. We understand that banks exist, we understand that they hold our money. Some of us know they charge fees. But the actual mechanics, the way these institutions are designed, structurally, mathematically, to always come out ahead, that's the part most people have never sat down and thought through. And once you see it, genuinely see it, you can't unsee it. This isn't about blaming banks or turning them into villains. It's just about understanding a system that, right now, whether you realize it or not, is shaping your financial life. And I'd rather you understand it with your eyes open. So let's slow down and actually look at it. Here's what most people think when they think about how banks make money. They think fees, service charges, ATM fees, maybe interest on loans. And they're not wrong, those things exist. But that's like saying a restaurant makes money by selling napkins. Technically true. Massively incomplete. The real picture is much more interesting and much more layered. There are three core ways banks make money, and they work together like a machine. Each one on its own is significant. All three running simultaneously across millions of customers, across decades. That's how you end up with some of the most consistently profitable institutions in human history. Let's take them one at a time, and then I'll show you how they connect. The first one is the one that genuinely blew my mind when I first understood it properly. And it starts with a simple question. When you deposit money into your bank, where does that money actually go? Most people assume it just sits there, in a vault somewhere. Your name on a little digital ledger. Safe, waiting, ready when you need it. That's not what happens. When you deposit, say, $1,000 into a bank account, the bank is legally allowed, required in fact, within a system called fractional reserve banking, to lend out the vast majority of that money to other people. In most major economies, banks need to hold back only a fraction of deposits as reserves. The rest? It goes back out into the world as loans. Here's what makes this genuinely strange. In the United States, the Federal Reserve actually dropped the reserve requirement to 0% in March of 2020 during the pandemic response, and it hasn't been formally reinstated the same way since. Other countries have their own ratios. The UK, India, Australia, they all work slightly differently. But the principle is universal. Banks don't just store your money. They put it to work. So think about what that means. You deposit $1,000, the bank lends out, let's say, $900 of that to someone else as a loan. That someone deposits their loan proceeds into their own bank account. Maybe it's a different branch, maybe a different bank entirely. Now that bank has $900 and can lend out $810 of it, and so it continues. Economists call this the money multiplier effect. One deposit, cycling through the system, can theoretically generate several times its original value in total loans across the banking system. Your $1,000 becomes, through this chain, potentially several $1,000s worth of lending activity. And who pays interest on all those loans? The borrowers do. Not you. You're the depositor. You get a fraction of a percent. The borrowers pay 7, 8, 10, sometimes 15% or more depending on the type of loan and their credit profile. The bank is the middleman in every single transaction, and the gap between what they pay you and what they charge the borrower, that's called the net interest margin. And it is the beating heart of banking profit. Let me make this concrete, because numbers help here. A mid-sized bank in a developed economy might have a net interest margin of somewhere between 2 and 4% annually. That sounds small until you realize it's applied across tens of billions of dollars worth of assets. JP Morgan Chase, one of the largest banks in the world, had net interest income of around $89 billion in 2023 alone. That's not total revenue. That's just the interest spread. And on the other end of the spectrum, think about the savings account sitting in a typical European bank right now, or in many parts of Asia. You might be getting 0.5%. Some accounts in Japan have sat at near zero returns for literal decades. Meanwhile, mortgage rates, car loan rates, credit card rates, those are nowhere near zero. They never were. The asymmetry is built in. It's not an accident or a bug, it's the design. Now, I want to talk about the second revenue stream, because this one is more personal. This is the one most of us have felt directly, even if we didn't fully understand it at the time. Fees, not just ATM fees, although those are real. I'm talking about the entire architecture of charges that banks have designed over decades. Monthly maintenance fees if your balance drops below a threshold. Overdraft fees, which, globally, have been one of the most controversial and scrutinized charges in retail banking. In the U.S. alone, banks collected $5.8 billion in overdraft and non-sufficient funds fees in 2023, according to data from the Consumer Financial Protection Bureau. That number has come down from a pre-pandemic peak of around 11 to 12 billion annually due to regulatory pressure and policy changes at many banks, but it's still staggering. And here's what makes overdraft fees particularly striking from a psychological standpoint. They fall hardest on the people who can least afford them. Studies consistently show that overdraft fees are disproportionately paid by lower-income customers, people who are already living close to the edge. The person with $100,000 in their account never sees an overdraft fee. The person with $40 left before payday gets hit with a $25 or $35 charge on a $12 transaction, and then sometimes another charge if they don't fix it fast enough. There's a quiet cruelty to that math that I think is worth sitting with for a second. Beyond overdraft, there are wire transfer fees, foreign exchange margins, which is the spread a bank takes when you convert currency. There are fees for paper statements, fees for certified checks, fees for closing an account too early. The list is genuinely long, and individually, none of them feel like much. That's the point. They're designed to be small enough that you absorb them without really thinking about them. Collectively, across a bank's entire customer base, they add up to billions. The third revenue stream is a little more sophisticated, and it's where things start to feel a bit like a magic trick. Banks don't just take deposits and make loans. They also invest. They buy government bonds, mortgage-backed securities, corporate debt. They trade financial instruments. They run wealth management divisions that charge fees on assets under management. Large banks have investment banking arms that advise on mergers and acquisitions and take a percentage of the deal. JP Morgan, Bank of America, Deutsche Bank, HDFC Bank in India, Commonwealth Bank in Australia. These are not simple deposit and loan institutions. They are diversified financial conglomerates with multiple engines running simultaneously. And when one engine slows down, say when interest rates are low and net interest margins compress, another one often picks up the slack. This diversification is part of why major banks have survived economic crises that would have destroyed almost any other type of business. The 2008 financial crisis nearly broke the global banking system, and it took enormous government bailouts to prevent that. But for most banks, most of the time, the diversified model is a profound structural advantage. They make money when you borrow. They make money when you save. They make money when you spend. They make money when you invest. They're positioned on almost every financial activity a person can do, and they take a small cut of all of it. Now here's the part where I want to slow down, because I don't think this is a story about banks being evil. I really don't. There's a version of this conversation that turns into a conspiracy theory, and I want to stay far away from that, because it actually obscures the real insight. Banks exist because they solve a real problem. Before modern banking, if you needed capital to start a business, you had to find someone willing to lend you money directly. If you wanted to save, you literally kept cash at home. The risk was enormous. The inefficiency was staggering. Banking, as a concept, created the infrastructure for modern economic activity. The ability to take someone who has excess capital and connect them with someone who needs capital is genuinely valuable. The issue isn't that banks make money. Of course they make money. That's why they exist as private businesses. The issue is whether most people understand the terms of the relationship they've entered. And most people don't. Most people walk into a bank relationship the way they walk into a mobile phone contract. They scan the terms, sign the bottom, and assume broadly that things are fair. And maybe they are in a technical legal sense. But fair and transparent are not the same thing. When your savings account pays you 0.5% and inflation is running at 3 or 4%, you are, in real terms, losing money. Your purchasing power is declining. The number in your account might be going up slightly, but what it can actually buy is going down. That is a fact that almost no bank will ever volunteer to tell you. So where does this leave you, practically speaking? The first thing is just awareness. Understanding how the system works doesn't make you powerless. It actually does the opposite. Once you understand that the spread between deposit rates and lending rates is how banks make money, you start to ask different questions. Instead of, is my money safe in this account? You start asking, is my money working as hard as it could be? High-yield savings accounts exist in most major markets and often pay significantly more than standard accounts. In the US, some high-yield savings accounts have offered rates above 4 or even 5% in recent years as interest rates rose. In India, small finance banks have offered savings rates well above what major national banks pay. In the UK, fixed-term ISAs have consistently outpaced standard savings rates. The options exist. They just require you to go looking for them rather than accepting the default. The second thing is understanding credit. If you carry a balance on a credit card, you're almost certainly paying somewhere between 15 and 30% annually. That is the bank's net interest margin on the lending side, working against you. The single most powerful financial move most people can make, not the most exciting, not the most glamorous, is paying off high-interest debt before they do almost anything else with their money. The math is brutal. Every dollar you owe at 20% interest is a dollar that needs to earn 20% somewhere else just to break even. The third thing is fees, or more specifically, the practice of noticing them. Go through your bank statements, not to stress yourself out, but just to see them clearly. What are you actually paying? Monthly fees, transaction charges, currency conversion margins? Are you getting value equivalent to what you're giving? There are now online banks and fintech companies in most countries that have eliminated most of these fees entirely. The competitive landscape has shifted significantly in the last decade, and the options available to an average person today are genuinely different from what existed 20 years ago. None of this requires dramatic moves. It doesn't require you to stuff cash under your mattress or move to a credit union in protest. It just requires a little more intentionality than most of us bring to our banking relationships. There's something quietly reassuring, I find, in understanding systems. Even when what you learn isn't entirely comfortable, because the alternative, not understanding, just going along, doesn't protect you from the system. It just means you're navigating it without a map. Banks are not going away. You probably need one, or something that functions like one, to participate in modern economic life. That's fine. Using a bank doesn't make you naive. What matters is using it with your eyes open. You now know that your deposit is not just sitting in a vault, it's being deployed. You now know that the rate gap between what you earn and what borrowers pay is the core of the business model. You know that fees are architectural, not accidental. And you know that the bank's diversification means it has revenue streams you'll likely never directly interact with, running in the background while you focus on your monthly balance. That knowledge doesn't give you superpowers, but it gives you something real, a clearer picture of the relationship. And in any relationship, financial or otherwise, clarity is almost always better than comfortable ignorance. So start small. Look at your savings rate. Look at your credit card rate if you carry a balance. Look at what fees you've paid in the last 3 months. You don't have to fix everything at once. You don't have to become a financial expert. You just have to start asking the question the bank would prefer you didn't. Is this actually working for me? Because now you understand, at least in part, how it's working for them. Until next time, keep your eyes open and your questions louder than your assumptions. See you in the next one.